Bill Campbell joins us right now to kick us off to the close, Global Bond Portfolio Manager at DoubleLine. Bill, great to see you here. Let's start with the dollar here. Weakness once again. This wasn't necessarily a surprise coming into this year. I know a lot of people had bet on some material weakness in the dollar. I'm not sure they bet on this much weakness in the dollar. And the big question is this temporary, or should we just kind of prepare ourselves for a longer-term structural shift lower?
Romaine, thank you for having me on. I don't think I'm going to argue with Paul Tudor Jones on this one. I'm going to add actually an additional factor to his view that this is a longer-term structural trend lower in the dollar, likely over the next several years. Beyond just the easing inflation data and softening employment data, bringing forward the potential for Fed cuts, maybe to the fall or at least the end of this year, I would say that the real fuel underlying the structural view that the dollar can go weaker over the next several years is the unwinding of all the foreign investment that's come into the United States over the past 2 decades. And more specifically, we've seen a ramping up of foreign investment over the past decade. Yes, we've had U.S. exceptionalism with high growth rates compared to other developed markets, with higher earnings growth rates relative to other developed markets and higher multiples. And what that's done is, if you look at the BEA data, it shows that today, or as of the end of 2024, which is the latest data available, there's $62 trillion of foreign savings sitting in the United States in one form or another, whether it's portfolio investments, direct investments, or an additional investment such as real estate. Now, the first part of this dollar move that we've seen this year, in my opinion, is more driven by foreigners hedging all of that investment in the U.S. For the past decade, they've had the luxury of a relatively strong dollar, keeping the need for FX hedges relatively low. And that's been good because FX hedges are costly to foreigners. Currently, most foreign countries are looking at FX hedging costs between 2% and 4%. But now with the dollar trending down, those FX hedges have moved up. We saw the Taiwan lifers, it looked like last night, increasing additionally their FX hedges. But that's just the first part of the move, Romaine. I think that there is a lot of runway for the dollar to move lower over the coming years.
What about with Treasury yields? And I mean, if that is what's occurring with regards to the impact on foreign investors, what becomes the effect on Treasury yields?
What a great question. And Alix had set this up nicely with a wonderful question as to, is this a structural break between higher Treasury yields and the lower dollar? And quite frankly, we at DoubleLine would answer yes. We do think that there is now a fundamental structural break happening. Not only is there going to be some reallocation, even if it's small, of that $62 trillion, that's a very large number when put into market context of foreigners, holdings of U.S. assets. But we also believe that the additional fiscal pressures, which have been very well covered, have increased term premium and will continue to do so. But one item that has been losing some of the headline attention is that both the Fed and global central banks continue to reduce the size of their overall balance sheets by purchasing less government securities. They're less involved, in global government bond markets. That also increases the need. So not only do we have increased supply, but we have a price-insensitive buyer that continues to step back in global central banks. And we think that this is a situation that doesn't have an end in sight, not only with the U.S. bill, working its way through Congress right now, seeming fairly large, but the U.K. is bumping into similar issues, Europe as well, where you're seeing the need for increased infrastructure and defense spending, and then also Japan.
So, Bill, and that's in essence also why we're seeing a lot of central banks buy gold at the end of the day. All right, Bill, so give me your best investment thesis with this in the backdrop.
So what we're advising investors to do is, one, don't panic. We like, and I might borrow from your clip of Paul Tudor Jones at the beginning, that we also believe that the curve will continue to steepen. We think that eventually the moderating inflation and softening labor market allows the Fed to cut interest rates, but that term premium, as we discussed, keeps back pressure to push back-end rates higher, and that's going to be a global phenomenon. So we like investing across developed market global government bonds in the belly to maybe the 5 to 10 year sector at most, but more in that front end to the belly of interest rate curves. Secondly, we're talking to investors about thinking on pullbacks or when the dollar increases, adding to international exposure. We think that over time, international exposure is going to benefit U.S. portfolios, and that's going to provide a decent diversifying offset in global fixed income portfolios going forward. And then for the time being, we still are favoring higher in quality credit trades as credit spreads remain very tight. Yeah. It remains difficult for us to, allocate too aggressively to lower yielding or credit, opportunities.
All right, great stuff, Bill. Great insights out of you and really everyone over at the DoubleLine team. Bill Campbell, Global Bond Portfolio Manager at DoubleLine.